All right, guys, what up? My name is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse. So I was thinking about it because right now in the current markets, it's it's pretty volatile. And if you've been watching all my videos, I've been explaining for 3 months, that we're kind of coming to tops, and these are the things we need to look out for. And these are the historical facts, and I was able to identify that stuff very early before people on television even were, and now they're figuring it out. But now it's too late. I mean, we're dropping significantly, and I started this months ago. But I wanted to just kind of make a video for you guys. I'm sure a lot of people are scared, and I'm sure a lot of people don't know what to do. And in this video, I'm going to go through different things that will help you navigate the situation. And these are going to be really good rules, not just for this market, but in general for investing or trading. The very first thing that you want to do, let's maybe find like something else to look at here. Now, when you're watching this video, the market is coming down, so there's not going to be a lot of bullish trends on the daily. But as an example, let's take AMC as an example. Okay, so this purple line is the 200. Okay, anytime that you look at a chart, or you look or you're interested, in buying a stock or a crypto, make sure you pay attention to the 200, okay? Is the price action above the 200? If the price action is above the 200, that's a good sign. That should be your first condition, okay? Because above the 200, you're still in an uptrend, okay? Now, it's best if the 200 is trending up, okay? See how this one's going sideways and then down? That's a telltale sign that, you're either going sideways or coming down. All right, now let's put some more EMAs on this one, which is called AMC, just so we can kind of see. So moving averages and exponential moving averages show trend. Just like the purple one is the 200, well, the 50 I have is the bright blue, the 30 I have is the yellow, and I have the 20 as the purple, and the 9 as the 9. The green is the 9, excuse me. Okay, so what you want to do is you want to make sure that you're in an overall uptrend, and that it's best to decide on how to enter and how to exit. And one of the best ways to do that is to take a look at the price action and the chart and understand the personality of the stock. So if you're if it's kind of, doesn't have the best earnings, maybe it's speculative, it's got momentum, then maybe what you do is you just make sure that you're above this 200, and you just come in when it comes above the 9 EMA. So let's take the 20, the 30, and the 50 off as an example, just to show you. And like right here, so you're above this, and your price action, which is the green, the light green, goes above this bright green, and you buy it, and you just stay in until it comes down. Now right there it sells, and then you can just rebuy, and then boom, it's gone. And then comes down, you rebuy, it fakes you out, and it sells. And then you skip all this. Well, you do that because every single day what you do is you come over and you see what the price of the green line is. So today's price, it's over here at $20.08. But if you did it over here, it would have been $56.03. So as an example, you're in an uptrend, and you have a rule and condition to get in based on the personality and characteristic of a stock. So right here, if you would have bought AMC at $10.02, and you traded in and out a couple times, but essentially you went to $56.52. That's a 500% gain just using that rule and condition. What you don't want to do is try to fight the trend. Everything is about the trend and the direction of the market. So first you want to look at the indexes, okay? The Dow, the Russell, the SPY, and the NASDAQ. Are they in an uptrend? Okay, if they're in an uptrend, and all four of them are in an uptrend together, they're not diverging, then the market is healthy, okay? And if for some reason, if one of them, like the Russell, is coming down on the index, then you know that the small caps that are within the Russell are going to come down. If the NASDAQ is coming down and showing weakness on the index, then the biotech and technology and information tech, they're going to come down. So you want to have a rule to exit, and you also want to be paying attention to those indexes every single day. So let me grab my main chart so it's a little easier for me to explain things. Okay, here we are. We have the NASDAQ as an example. So when the NASDAQ, don't worry about all the indicators. That's for when you're in my courses and you're a Jedi and you want like super precise type trading, and you want to use like the compound system and the probability system. But let's just imagine you don't know that, and you just need to be able to kind of look at what's going on. And what I want to establish with you from the beginning, moving forward, I always want you to be thinking about the direction of the market, the direction of the indexes, and the trend, okay? So like as an example, this is the NASDAQ, and this blue line is what's called the primary trend, okay? As you can see, it's been strong and trending up. Now, that's the 200 that I was showing you, the purple. Notice how it's going up. Okay, so it's trending up. The ribbons or the EMAs I was just showing you, that's also going up, and it's colored blue, which means it's in an uptrend. So what you're looking for is the trend, okay? So right here, we're on the NASDAQ, it's tech, and this whole time, tech was popping. And I can tell you it was popping because the index for technology was in an uptrend. So therefore, if you were purchasing things like Square or PayPal or any of these companies during this time period, they most likely were incredible for you, okay? And many tech companies are in this index, okay? Now, to get a little bit more detailed, now that you understand you're looking for the trend, and this is the primary trend, you need to understand what the secondary trend is. The secondary trend is this, okay? And let me color it yellow. All right, now, the reason people use the secondary trend is because they establish that they are in an uptrend in the primary trend, and they want to invest in the stock or the index or the crypto. But they're not sure if purchasing, up here is the best thing because they don't know if it's going to fall, even though it looks like it's in a strong uptrend. But lo and behold, it does have a pullback, which is very natural in an uptrend. And there is a primary trend, a secondary trend, and then there's minor trends, okay? And we'll go through that really quickly. So you establish that you want to buy this. Let's say you're buying the NASDAQ. You're in an uptrend, and you didn't know about the accumulation phase, which I'll give you a quick brief on that here in a minute, where institutions and smart money buy. But you at least have established that you have a secondary trend pullback, and what you do is you wait for that to do its thing. You've established that you want it, and you've established that you're in an uptrend and you're still above that 200 for those conditions, okay? So now you technically buy right here because you're buying in an uptrend, okay? It's different than, and you do that once it's already started the rally with like a follow-through day or a couple days is not a bad idea. It's okay. You don't have to get the rock bottom dollar. It's more important to establish the trend, establish the rally, make sure it's not a fake out, and that you're going in the direction. If your intention is to buy a stock long to make money going up, you're betting that the stock will go up, you're buying it long. Best thing to do is establish that you're in an uptrend above the 200. These are blue, and buying off the secondary after the rally attempt starts is a great place to do it, okay? Now, there are multiple phases in every cycle, and in the history of the stock market, there are multiple larger cycles that take place, okay? There's like a secular bull, and then there's a top and a crash, okay? And then it comes down, and then at the bottom, there's a big accumulation phase, and that's when everybody is really fearful, scared to death, nobody wants to get in the market, everything is negative on the news, and that's down in here, okay? And when that old old saying that Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. That pertains to the accumulation phase. So when everything on the news and everything you read and everybody's talking about, you know, fear and scared and it's crashing, like when maybe COVID was happening or the financial crisis, what'll happen is always on all charts, crypto and stocks, it'll come down. It'll make this red cloud, red ribbon on my chart. It'll go below the 200. Now, you guys notice right here, it's doing the same thing. It made a red cloud, a red ribbon, and it's below the 200. Everything goes in cycles and phases, okay? So this is what's called the accumulation phase. It comes down, it makes the cloud, the red ribbon, and the 200. It comes down, and it pivots up, and it pulls back, and it starts making higher highs, okay? Pull back, higher high, higher than here. Pull back, higher high, higher than here. Pull back, higher high, higher than here. Pull back, higher high, and it keeps going. And when it crosses the previous high, the previous all-time high out of the base, the previous swing high or all-time high, then it is truly safe and it is continuing on its upward trajectory, even though this might have taken a year, 2 years, 3 years, or 3 months. It doesn't matter. Now, the stock market will always go up, from my understanding when I look at all the indexes. There's always pullbacks, there's always corrections, there's crashes eventually sometimes, and after that it'll go back up. But what I'm trying to help you with is to identify when it's safe to get back in, okay? So I'm going to show you why I was telling people to sell on this candle. And then I'm going to explain why I told you to sell on this candle. And then I'm going to explain what these two candles mean in this current environment. But before we get there, I want you to understand this. When you come down through all this, you're supposed to be getting out, okay? You're supposed to be getting out, and in my courses I teach you how to get out right here, okay? And then, you know, you come up through the 200, that's a condition. The ribbons go blue, that's a condition. And for super strength and safety, you want to get past the previous all-time high base, okay? And then you're off and running, and this is what's called the accumulation phase. This is where smart money comes in, the trend is established, and it's safe to enter. And again, this is the NASDAQ, so you would be safe to enter NASDAQ type stocks, technology stocks. But most people, they buy up in here in the retail, okay? This is called the participation phase up here. They don't know. I'm trying to teach you where smart money does and how they're trained and how it works, okay? So, so now that you know that, you'll be looking for that on your crypto charts and your stock charts, and it's on every single chart, every index, and every crypto, okay? It's on every single one of them, I promise. And it won't be on one only if it's like a brand new crypto or a brand new stock for a few months. But if it's gone through a whole cycle, which most stocks have, and I'm noticing most cryptos have this already now too, then it'll be on there. It's just the way it works. They go in 4 market phases. This is the accumulation phase, okay? You establish the trend. And let's say you get in a little late, maybe you're waiting for a house to sell and you got some money, but you wanted to get in stocks. Well, now you're going to wait for the secondary trend, and you're going to wait for that rally attempt and get in, because the condition above the 200 in an uptrend against the primary trend is in your favor. So now you're going to buy. Okay, you're in, and you basically have an additional secondary trend. Okay, same thing. Now, this is when, now that you know and you bought right here and you caught this whole leg, you can either sell like I teach you in the course, or if you just wanted to hold it, you will know right here when it starts to rally that that would be a place where you can purchase more shares. If you notice, you're still making higher lows, okay? So even though you're buying the dip, you're buying the dip in an uptrend and scaling up, which is the right way to do it. You don't want to be buying the dip in a downtrend because you don't know where it's going to end. But as I show you in the secondary trend, you have established a floor and started a rally within an uptrend with your conditions, okay? So on and on you go. This is called a minor trend, this little one that I put here, and that's just kind of like a pullback on the way to higher highs, okay? Now when you get to the top, so you have this long uptrend, right? You have this long blue uptrend that shows the primary trend. Now, when you stop making higher highs and you start making lower highs, see how this one is lower than that, and then this one is lower than this? That's a new direction, okay? And in the 4 market phases, you have your accumulation, like I showed you, were smart money buys. You have your participation. You have what's called distribution. That's when it's selling. And then you have the opposite of public participation when it's coming down. And typically these things can come down. They make mountains, okay? Like, for instance, let's see if I can just find you this real quick. Just grab any watch list, grab one. So a good example of the 4 market phases, just so you could visually see, would be Alibaba. You notice how this has made a mountain. So there on the chart, you got the red cloud, the red ribbon under the 200, okay? Blue ribbon above the 200, and then past the swing high, which probably is right here, to be honest. This would be okay. It still might be considered a minor. The major would be over here for absolute safety. Okay. But that's getting in a little late, I would think. I think you could do a little better, and you could just, you know, kind of use the blue ribbons as the guardrail, make sure you're above the 200, and you kind of get in, okay? Now, it's a pullback. It comes below the 200. They tend to do that a lot. They wobble at the top of the distribution phase, and they wobble on the bottom on the accumulation phase. But notice how I have this white line. It's creating a trend. The more times that it touches, it establishes the trend and makes it stronger. Now, I've heard a couple people on YouTube that are actually very good with technical analysis, but they do have this one thing wrong. Some people have said when it touches multiple times, it weakens the trend or the support resistance. That's actually not true. The truth of the matter is, the more times it touches it, it strengthens it. Okay, so this has obviously touched a lot. Now, this is accumulation, and if you notice right here, I have a support. Okay, and this was 3 years ago. So it went through its thing, and you know, you don't want to be long when you go below the 200. That's bearish. So above the purple 200 is bullish, below is bearish. Okay, it does this wobble, gets a little tricky, and then it takes off, and it takes off out of this new base. So you grab it, and I mean, this Alibaba has definitely had its fair share of issues, as you can notice. I have not been in it through all this, but I'm just looking at the chart. But what I'm trying to show you is that it makes mountains, okay? The overall uptrend and the secondaries and the minors take place as it's trending up, and then it distributes, and then in the 4th phase, it does this, and it comes all the way back to the beginning. That's what I want to show you. That happens on all charts. So now that you know that, you know where smart money buys, you establish an uptrend, you have your conditions below you, you pick the stocks that are within the index, and now you're confirming certain things, and you're in a safer situation if going long is your goal. Now, if going short is your goal, you wait for distribution, you wait for the red ribbons, and you go short. And it's best to do the shorting when this red, the bottom of the red, so the bottom of the red ribbon is the 50, and when it crosses the 200, that's where a lot of people go short. It's called the death cross. And you can see it'll fight, and it'll come up, and it rejected, it comes down, and it rejected, and it's done its thing, and it's trying, and you know, on and on it will go. But if you notice, the purple, like I showed you at the beginning, see how it went in an uptrend, and then it went down, and it kind of flattened out. And when it flattens out, that's a telltale sign that it's ready to go. So as BABA went up in this purple 200 and it flattened out, that's distribution, same as accumulation. It's just at the top instead of the bottom. Then it goes down, and if you notice, a lot of people are like, oh, I want to buy the dip, or oh, you know, BABA is such a great price. And you know what? It is a great price. I'm not going to argue that. However, what they're missing is that this is still coming down, and every single time on every single chart, when it's about to go to the accumulation phase, this will actually round off and flatten off before it goes up. Okay, that's how I know not to be buying this currently. And that's why when people were buying and all these different supports coming down and it keeps breaking down, it's not ready. It'll tell you when it's ready. There's identifiers to when it's ready. Okay, So now that you know the 4 market phases, you know the conditions, now let's talk about some things to keep you safe. Okay, so you should not be fighting the trend. Okay, the trend is your friend, and the trading in the trend is the most important thing. The second thing that I would say is that's condition 1. You're going long in the trend, or you're going short in the trend. Next, you want to have kind of capital protection. So I have a chart built on a stock that I used to trade. I'm not in it anymore, but I know that I have the stops on there properly, and it'd just be easier so I don't have to draw them. So it was called Crocs. And all these blue lines are the stop loss points, and I'll break it down. So this is how you protect your money. Okay, so what are your rules? Here's that thing I showed you on every chart. Okay, red cloud, red ribbon, under the 200. What's your condition? Blue ribbon, above the 200. Off you go. You buy, and there, that first blue line right there that you can see, that's your first stop. So that's called low risk, and you're hoping for high reward. Now this one paid out huge, but you don't know it when it happens. The most money you should be losing is at the beginning, in case it fails on you and stops you out. And that's what this portion of the video is about capital protection and stop losses. So you know you're in the trend, you've met your conditions, you're looking for low risk, high reward. So you enter right above that 200 and you put your stop. Now, where do you put your stop? You put your stop at the bottom of the previous pivot low, okay? And you would do that based on the time frame that you're using. So if you're using the daily, well, then you would use the daily pivot low. If you're using the minute, you could use the minute pivot low. If you're using the hourly, you could use the hourly pivot low. And then there's ways you should always pad it a little bit. And I teach you that in the course, exactly like the exact number to pad it to avoid liquidity wicks from market makers, okay? But, you know, that's a little bit, you know, more. We'll just go through setting stop losses. So low risk, high reward, meet your conditions, you're in the trend, and boom, you're off to the races, you go, and right here's a pivot low, so you move your stop from here to here. It keeps going, has a couple down days, there's a pivot low, but it didn't stop you out, so you move your stop up to here. You're always lagging on your stops, okay? Like, it may go up $10, but your stop is still here. You're gonna wait for it to come down for a day or two and see if it stops you out. If it doesn't, you move your stop up and you keep going in the trend. Okay, here's another one. Okay, it didn't stop you out here, so you're just climbing. And you're climbing and you're climbing, you're using these pivot lows, and this one almost stopped you up, but it didn't, and you moved up to here. And then, essentially, I mean, if you put one here, you did get wicked. You know, but you rebuy in, and you're still in the trend, and essentially you get this one, and then you hit a pivot low, and this yellow one, you make a stop, and when it rallies up and it comes down, it breaks you down. So you basically bought in right here with your conditions at $27.80, and you sold right here at $145.81. So let's find out how much that is. That's 537%, because you know how to enter, you have your conditions met, you're trading with the trend, your sector is healthy, you're using classic lagging stops to protect your bet. The worst is that you're going to lose at the beginning, but you're not going to lose a lot because it's low risk, high reward, and you're going to continue to let your winners run by moving those stops up. Okay, so now you got all that information. Okay, now what else? Okay, so when you're in a normal market, the best thing to do is focus your conviction on fundamentals, okay? That's going to be the core. And typically you want to have, you know, several years of good earnings. You want your earnings per share to beat not only the previous quarter, but the same quarter 1 year ago. And you want annual revenue beats, okay? You want to take a look at things like new products, services, management. You want to look at stuff like that, okay? And when you have good earnings, you go through what's called an acceleration cycle, okay? A good earnings beat, no less than 20%. It's best to be higher, 30%, 50%, 70%. They go way up in 500%. That's called a surprise, and a surprise is based off of Wall Street estimates. Wall Street estimates are analysts that are hired from institutions to follow a company and a stock, and what they think it will have, for its upcoming future quarters. So they'll make an estimate, and then when the company beats it, it's called a surprise. Now, a big surprise will create big momentum and acceleration in the stock price. However, if the Wall Street analyst estimate says 30 cents a share, and the company comes in at 30 cents a share, the stock price is going to fall, and it's going to fall hard because everything is discounted in. It's future discounted in. So they only met expectations, so it's going to drop. They did not beat it and give a surprise. So you want to find companies that have good earnings and have for a while. And then what you want to do is you want to, now that you know the index is healthy, you're in the trend, your conditions are met, you're low risk, you're high reward, you have good earnings, okay? Then you want to take a look and make sure that big institutions are buying it and have institutional support, okay? Because that protects you, just like algorithm trading will protect you on these big EMAs as well. All right. Then what you want to do is you want to get your money in super good. So you find the hottest sector, but not just the hottest sector. You find 1, 2, and 3 of the best companies that are leading the pack of the entire sector. So now you're in the hottest sector. You got the leader with the best earnings, and it's making the biggest price increase within the trend. Now you're making money. Your winners are running, and you're just moving your stop up, and it's going on autopilot. That's kind of in a normal market. Now, when I'm filming this, we're kind of walking into potential devastation, and we've topped, or we're topping, and we're coming down, and we could be going into a crash, recession, and I have videos on that. And you guys should watch that. I posted those a month ago, weeks ago, whatever, kind of preparing you before all this happened. So now, you don't want to just ride it out. The goal with investing is to ride the trend and have parameters for selling with the stops. But you also need to have a max loss stop point of the max that you're willing to lose, which is 8%. Okay, 8% gives you enough wiggle room for the stock to move, but it also lets you know if the market is not right or something's just not going to go right with that trade, and you're going to mitigate your losses at 8%. If you had 10 of these trades going, okay, and you had 100 grand and you had 10,000 on 10 different positions, and something horrible happened out of the blue, you woke up one morning and something devastating happened, and they all got hit. Well, the most that you lost was 8,000, and you still have 92,000. So you want to always have that safeguard, that fail-safe in there, okay? You don't want it to get hit, just like you don't want to get your stops hit, but just in case you have it in there, okay? Now, when the market is super, super volatile, it's best to lower all of these things down to a lower time frame. If it's somewhat shaky, you can be on the 4-hour. If it's pretty shaky, you can be on the 1 hour. If it's really, really shaky like it's been lately, you want to be on the 1 minute, and you want to be using these ribbons and trading momentum, okay, up and down. So you go with the trend. So right now, if the ribbon is red on the daily and you're below the 200, you don't want to be going long. You want to be going short. You want to trade with that trend, especially if it's under the 200. It's unfortunate that Crocs, a great company, or Microsoft, or Nvidia, or soon to be Tesla, these great companies are below the 200 or having red ribbons, and people are going short. But you can't be emotional, because the leaders that make you the money on the way up are the leaders that make you the money on the way down. Okay? So everything goes in cycles. And there's an acceleration cycle with the earnings, with the surprises, that ends up being a higher price and a higher PE, and then there's a deceleration usually due to earnings or something to do with the company, a scandal, whatever, and it'll come down, and it'll come down to low PE. Or there's just a natural pullback, market crash, something like that, and it will, it'll come down. All right, so, but the Teslas and NVIDIAs that were in the right sector and the leader, they had high PE because they had high supply and demand, and people were willing to pay more for it. They were willing to pay a higher price for that. Well, those ones, are going to come down, and when they have the conditions met, like the red cloud, red ribbon, and under the 200, you can go short and feel safe that you have the protection of the red ribbon, okay? Especially on the daily. Now, it's really powerful when you identify, if let's say you wanted to short this, you identify that you have the protection or the pressure, of the red ribbon on the daily, the 4 hour, and the 1 hour. Notice how you're below this as well. And then what I do, if I'm going short, is I will wait for this thing to do one of these where it makes a blue ribbon, and then it goes red right under the 200, and I will buy it because I know that on the 1 hour, the 4 hour, and the daily, I'm in an overall downtrend. And what I'm doing is just getting the best price on the lower time frame. Okay? Now, right now in this market, if you're watching this video, which is January 2022, which is about to be one of the worst Januaries ever in the history of the stock market. Now, I'm going to tell you a little trick. If you don't know how to short and you are not a professional trader and you're not really comfortable with technical analysis, and this is maybe a little overwhelming, the market environment, you have two options. And listen to what I'm going to say, because I'm going to really give you very, very good suggestions right now. If you're nervous and you're fearful and you're unsure and you don't know what to do, you have two options. Number one, stay out. And you should already be out because your stop losses have been hit and you've been moved to cash. That's the thing about the stop loss. If you get your winners running, you low risk, and then boom, stop. And then it goes up, stop, goes up, stop, goes up, stop, goes up, stop, goes up, stop. And then the market comes down and it moves you to cash, all your principal and all your profit. It naturally does it because you have a system and you have protocols, conditions, and parameters in place. Okay, that's how you need to do it from here on out, okay, guys? Now, if you still want to be in and you don't want to just be in cash, that's okay. Let me show you. You're going to want to write it down, but I'm going to show you the easiest way to do this, okay? Instead of trying to short a whole bunch of stocks, what I want you to do is simply get the Bloomberg on, okay, or your Yahoo, and look at the indexes, okay? You're going to be looking at the Russell, the NASDAQ, the SPY, and the Dow, okay? Now, if the NASDAQ is coming down, you're going to buy SQQQ. So as it's going red and getting deeper red, you're just going to load up on SQQQ. And the best way to do it, what I do is I do it off the minutes. Okay? Now, when this is going up, like it is on the minutes, it's above the 200, which is 200 minutes, okay, not 200 days like the daily. Okay, it's above this, and the blue ribbon is showing an uptrend. That means that the Dow is coming down, that it's a pretty bad red day, okay? So you just buy SQQQ, and you're now making money when the NASDAQ is coming down. Okay, let's say that the Dow is coming down. You buy SDow, okay? Same thing. The Dow is coming down 400 or 500 points, and you buy this, and this is going up. Now, this is what I want to kind of show you. All right. Let's see if I can find you a good example. Okay, so this is inverse trading. Let's see if I can find you a better example here. They all look the same. The reason they all look the same here, I know how to teach you this. Okay, all right. So there's your SQQQ. All right. Now let me grab two charts. And on this bottom chart, I'm going to go ahead and grab an index, Okay, and I'm going to grab the NASDAQ. Okay, now this is the best way to do this. So let's go to the daily on the NASDAQ. Okay, the NASDAQ's on the bottom, and I'm going to show you the trend. Okay, and the shorting the NASDAQ, but you're buying it long. You're buying it just like you buy your regular stocks. You don't have to short anything or buy to cover. You just buy SQQQ. Now, let's look at the dates. So this down here is March 20th. Let's go find that over here. And I can pretty much tell you it's probably right here. Nope, that's 2018. Here it is. Okay. So right here, try to get it all in there for you. Okay. So this dip right here when it came down, and then COVID, this SQQQ went up. And look how far it went up. It went from 403 to 802. It went up 100%. So as this one comes down, you buy this one to go up. Now, we were in a big bull run on the NASDAQ. Therefore, this one came down, okay? But as this starts coming down with the red ribbons, okay, you're going to notice that this is starting to come up again, just like it did before. So this is a hedge. Now, if for some reason you had longs open in a downtrend, which I highly do not recommend, I do not recommend dollar cost averaging in a downtrend. You don't do that. You do that in an uptrend. And you never buy the dip. Never buy the dip, okay? Never do that. And if you didn't have capital protection and you're not in cash, which I highly recommend that you should be, and you do have longs open, you need to put a hedge on there. Some people will put puts on there as an insurance policy, which is smart. I mean, it makes sense. It's something I might do. But instead of doing that, I tend to do this. But they both do the same thing, and it's really good to have that hedge if you're going to have longs open. I don't have longs open. I trade in and out every day, lots of trades in this market, and then I close my trades at the end of the day and I take my money. But I watch the indexes, and it's very easy for me to just throw on SQQQ, SDOW, and SPXU. And you know, when the SPY is coming down, the NASDAQ and the Dow. Okay, now I can get a little bit more complex and technical, and you know, but I want to just kind of keep this easy for people that are nervous. Maybe they don't know. They, you know, either were listening to the wrong person, or maybe the person they were listening to told you correctly, but you didn't apply it. Whatever the case is, this is a way to stay in the market if you didn't want to just be in cash while the market's coming down and being super volatile. Okay. Now, eventually, just like when you find market tops, you're going to find market bottoms. And I will be able to show you when the time comes when the bottom is, so you don't buy the dip. Okay, right now we just got another 200 and it's just now going flat. Okay, then it's going to come down, and we don't know how long it's going to come down for, but when it does, it'll eventually flatten out, and then you'll go back through that accumulation phase where smart money buys them when everybody's scared on TV. So right now you should be in cash. Your biggest leaders that went up are probably going to be your biggest money makers going down. If you don't understand shorting or you're intimidated by it, just buy the inverse of the index, which is SDOW for the Dow, SPXU for the SPY, and SQQQ for the NASDAQ. Okay, very simple. All right, and put the pressure on that, but make sure you're following the trend. So as long as the NASDAQ's coming down, you could have that going for yourself. And just so you know, in this video, like at the time of this video, the whole market is crashing in 2022, and every day I've made money in January, and this is one of the ways that I've done it. Now, I was up 30%, 35%, 50%. I'm pretty close to 70% up on my money. Now, I do a lot more than what I'm teaching you. And I can teach you that in the Discord, where you have the courses and the one-on-one coaching and the Wheelhouse Wednesday group training, and you have all that stuff. And I teach you a lot more. But this should help you, you know, understand the direction of the indexes and the direction of the stock. Like, for instance, let's go look at some stocks real quick. Okay, so let's say you want to buy Tesla. Okay, Tesla is in a downtrend. Okay, it's making lower highs. Okay, had a failed attempt breakout, another failed breakout. It's actually breaking supports. This is a descending triangle. It's a bearish pattern. This was an uptrend. Blue ribbons. It went on to make you 600 bucks. It got shaky, kind of did its thing, came down, you know, rally attempt, and it's failing, and now it's going to be breaking probably through supports. You never know. They could break out as their earnings coming, but, you know, the volume is, I mean, everything's bearish on it right now. Another one that we could just look at really quick is Microsoft. Okay, Microsoft is an iceberg. It's a juggernaut. It has a red ribbon. Now, let me tell you something about Microsoft. I've been in the stock market a long, long time. I've been doing this for a long time. And Microsoft does not get red ribbons too easy and too often. The last time it had a red ribbon was COVID. And everything had a red ribbon there. It takes a tremendous amount of force to make Microsoft get a red ribbon. That is an indicator that the market is coming down. If Microsoft should be the last one to get a red ribbon, and it pretty much is, and it has one right now. So, do you go long on Microsoft and buy the dip? No, you don't buy the dip, because you have lower highs, a red ribbon, a red cloud, and you need to see if it's going to bounce off this 200 EMA or if it's going to fall. If it falls, you actually probably would short it. If it bounces and creates a follow-through day and there's a rally attempt and some things like that, then that's a different story, okay? Because you've established a pivot, you've rallied and established that, and then that's a whole different deal, and this red cloud will go blue, and you're starting to get momentum. However, you probably need to get at least through this pivot low or swing low to establish a minor trend reversal, which is, you know, you got a few steps to go. So you got to pay attention to this stuff, okay? And here's another one, okay? I love this stock, but I have no problem shorting it if I have to. FTNT, love it, just like I love Crocs, Nvidia, and Tesla. I mean, they're leaders. I just love this stock. I mean, I absolutely loved this stock. Made a bunch of money on all those. But hey, I trade with the trend. I go in the direction of the trend. And I don't argue with the market. I am non-emotional. If the market says we're going up, I just go up and I don't question it. If the market says we're going down, I just go down. I don't question it. I trade with the direction of the trend. I do not fight the market. I do not fight the trend. I do not fight the consensus. Okay? The consensus is always right. It'll show up in the trend. It'll show up in the market. So I hope this video helped you with a few fundamental key tips to help guide you in investing and trading and what to look for to enter safely and to exit properly, and the conditions that need to be met. If you have any questions, let me know in the comments, and I did put the Discord link in the description below. You can click that. You can come in for free. You can talk to me. You can talk to everybody else, and if you want to upgrade, just go to Start Here and you can subscribe. It's $99 a month, and I teach you a tremendous amount about markets, trading, investing, techniques, strategies, advanced techniques and strategies, and you'll come out of there like pretty savage. So thank you for watching to the end. I appreciate you. My name is Chris, and welcome to the Wheelhouse.